Welcome to the second panel of the day. We're going to talk about IPO and the readiness of IPOs going to come. So just now we heard about like how the landscape is so far. We see some stabilization after some kind of choppiness, and finally we arrive at quite a good spot, I would say. So let's talk to our panel members about like what's going forward. What are they doing behind the scene? Shall we start with, well, let's introduce our panel. We have Sherry from KPMG. She's a partner of National Capital Markets Readiness. We have John next to her. He's the National Director for SPAC, which is a very interesting segment. We might even see something coming back. Ramy, who's a partner for Capital Markets and M&A with Vincent and Elkin, and Justin, sitting next to me, who's Director of Strategy at DFIN. I'm a reporter for Equity Capital Markets, which includes IPO, convertible bonds, and secondary share offerings. Well, shall we start with Sherry? I'm very curious. So, are we in a good spot? What are we going to expect for the second quarter?
Well, definitely things are looking up from a 24 perspective. So definitely I think continuing to see that momentum, which is great. And so I think, as the topic is readiness and the road to IPO, we certainly heard, I think, some very important things in the first panel that are the types of things that we're advising our clients to be very focused on. So my background is in accounting reporting, so I'll start with that first topic that we heard of, getting financials in order, keeping them current. Even though, there's a cost to that, it certainly helps in moving quickly when the window opens. So that's certainly something that we're working with our clients on. Also, forecasting is so important. We saw that was maybe one of the issues in 21 with the, the significant market is that the projections weren't necessarily there. And so I think being able to forecast with confidence and in timely manner is very important. So that's something that companies should be working on now while they have the time, while they're positioning for whether it's later in 24 or even in 25. So those are the types of things that companies should be focused on. And then I think the other topic that we heard was around investor meetings. And I would definitely say that, more meetings, earlier meetings certainly is an opportunity to create awareness and understanding in the marketplace of the company's business. Helps generate, a sense of what's the demand out there, maybe at various valuation levels, and really just gives the company that practice. So I think that's another thing we heard is act public. Certainly the more you do that, the more you operate as if you were a public company, even while you're private, are some of the things that I think are going to create success in the market for companies on that IPO journey.
Ramy, I'm very curious about how many companies are you working on? Because technically, second quarter is going to be the longest window that we're going to have for this year, given how election is going to be. And then, so we've seen Nasdaq talking about moving the timetable slightly forward. So how many are you working on? What is the latest that people can actually go and plan for an IPO?
Well, I've got a couple who are actively looking currently and have been working on it for a while. I think every company's different, and obviously everybody knows that. But being ready both with reporting, but also with any sort of operational milestones that companies are going to hit, and making sure that those are reflected and those are proven so that you could hit a market here in Q2 or early Q3, I think is really the key. On the last panel, we heard about people talking about sensitive topics, down round, pricing, et cetera. Again, every company is going to be different, but making sure that you're ready with, okay, who's going to be on the board, at what price are we willing to go forward, and then is there something in the future that we think if we wait until Q1 of 25, we're going to be in a better place if the market's still there. Those kinds of conversations, for some companies, it's really easy. If you're a founder-backed company, it's like, I only care that I control the company coming out of it and maybe a little bit of valuation. If you're owned by hedge funds, it's going to be a much harder conversation. So having those conversations early, particularly when the market's going to be potentially open for a very brief period of time, is kind of the key, at least from my point of view.
I'm curious, John. So you're responsible for a segment that's been kind of like hampered, and essentially the reputation has been so good for the past 2 years or so. I'm curious. So the readiness for you, is it really about kind of preparing to tell the story? What is the preparedness going to be?
So I would say that everything that the other professionals on this panel and the panel prior everything that they're doing surrounding readiness is really critical to get into the submission process. So I think the one thing that the SPAC market illustrated very well is that the public market was not built to sustain the high failure rate associated with early stage venture style investing, right? So when you looked at the data throughout the boom, when I was tracking that, it was demonstrable that companies that were coming out that they were private equity backed assets were performing demonstrably better in the aftermarket, right? And they had it was all readiness reasons. So they had access to audit-ready financials, they had professional executives, they had sophisticated PR and IR apparatus. They were ready to be a public company. So when you're talking about D&O, you're talking about oversight and accountability, any disruption to that or any impact on valuation to shareholder value. So anytime you can demonstrate rigor on the part of the team and the professionals surrounding the team to mitigate that risk, then you're gonna get a better result. Because I say it too often that insurers, contrary to popular opinion, insurers they're not averse to risk, they're averse to surprise. So the more that you can give them information, and then you don't even really have to be in a great spot at the time, you just have to show them a willingness for a partnership multi-year, and that's where you extract the best results.
This is very interesting, given the fact that we actually have Destiny ETF, which is essentially all private market, and essentially using the same logic, it's like, people are betting on earlier stage than kind of IPOs that are more ready. I'm curious, what do you think, Justin?
Certainly when you're going through a public process, there's an element of risk mitigation, right? Kind of what you were talking about with people aren't averse to risk, but they are averse to surprises. Then there's the uncertainty, which I think really impacts timing. That's when we talk about the election. It's uncertainty of the future, and whether you're going through a private transaction or an IPO, that's going to be a factor. And then there's what is your upside, your value creation after the event. I think what's really exciting to me personally is that a lot of companies exploring IPOs are running a dual track process, so they get a broader read on the market and the appetite through different routes. That does add an extra burden to your readiness because you are now exploring two very different types of transactions with different requirements. There can be some overlap, like forecasting and your corporate governance, your ability to report, whether it's going to be eventually to the SEC or if it's going to be to maybe a private equity owner or a large strategic corporation. Lots of overlap in that, but it does add some extra burden to that process.
When we come to dual track, I'm very curious. So there is a time, especially now, the market hasn't been open for a year and a half, and then finally it opens. Do people actually prefer IPO over M&A, or because it's just easier for them to actually just sell in one go, rather than IPO, which is, it takes like 2 to 3 years, especially if it's a private equity-backed company? Sherry?
I don't know that I'd say they prefer IPO. I think the optionality certainly is helpful. I think the cost of going through an M&A transaction, if they're just focused on that, will be less than going through the IPO process. And so it's all going to depend on valuation. So if they can get a valuation from an M&A transaction that's comparable to what they're talking about from an IPO perspective, I think they would probably lean more towards M&A. And we've seen, like, if you look at the numbers of how many transactions close in an M&A versus an IPO, it's certainly much more significant from an M&A perspective. But I think just having that optionality certainly gives some flexibility.
And I think on that, I mean, if you looked at the slides from the last panel, what, 15% was the average float sold in the IPO. So you retain a lot of upside if you only sell 15%. And then similarly, it's going to depend on your shareholder base. Like Viking was 85, 75% secondary. So that was the hedge funds who got it during the downturn selling out. So very, very fact specific. You know, a management team is not going to want to sell to a competitor. They'd rather go public and continue to be the management team. So really going to be fact specific.
Viking was backed by TPG and CPPIB, which is, we haven't actually seen a lot of private equity-backed companies, and that was more kind of a slight rescue financing during the height of the pandemic when nobody can take a cruise. What is the pipeline for private equity? Do you actually see a lot of them? Like, technically, they should be more prepared in terms of accounting, right?
Well, they should, because most private equity companies need to account for their portfolio companies with audited financials. So you should see more public company readiness. Sherry could comment on this a lot better than I can, in terms of audit quality will definitely be there. I think anecdotally, rumor has it that there is a massive amount of private equity-backed companies ready to come, and that you're seeing, instead of IPOs, you're seeing, continuation funds as a way to just sort of kick the can a little bit. So there should be a lot of pipeline opportunities there.
I'm curious because we're in a very specific kind of time and place where there are a lot of things being done, like the first panel said, with testing water. They've never actually seen so massive, and which I've talked to kind of IPO companies that actually got listed, and then if you talk to the CEOs, they were saying like, I've essentially seen every single investor under the sun for a very long time. Do you think that kind of practice, or what other practices after the pandemic or after this kind of lull in IPO is going to stay?
Let's see, what other kinds of practices? That's a good question. I mean, definitely the ability to do things virtually and remotely is here to stay. And I think maybe the things that we learned through the 21 boom that were, things not to do, those would be some important learning. So I would say, topics that we've touched on, but the importance of forecasting. I don't think that can be underscored enough. And so, that education to companies about get your process going early, practice, rehearse, fine-tune, leverage tools, make sure you've got the right team in place. I think that's something that's very important that, was probably a key learning coming out of 21 that hopefully companies are very focused on now.
And also probably agility, right? The preparedness to actually go at any time, even though we're kind of going into a phase of stability per se. So I'm kind of curious, like, what do you kind of advise on companies when it comes to timing?
Well, certainly I think you can get an early read by exploring like a dual track process. And before you get too far in, I think you can have enough conversations on both sides that very roughly, like if there is a market for your company. And you can always put it on pause, right? But I think the worst thing you can do is decide that you wanted to be public a month ago and try to cram a process through, because it's just too long of a process to get the result you're looking for. You're in a new market if you wait another 3 months. That private equity pipeline, we're seeing a big backlog of private equity companies. That doesn't necessarily mean they're going to go through exit processes, though. A lot of them are looking at a recapitalization, something that might extend their portfolio beyond that typical 5 to maximums of 7 years. We might see portfolios that are in the 8 to 11 or 12 years. So that pipeline will eventually come online, but it might be delayed another year or two.
And also, I kind of feel like we've always been kind of doom and gloom for so long that we're almost like have that mentality set into our mind. We've been kind of like looking at timing where people are like, oh, the window might close, and then it's almost like kind of unstable. But on the flip side of things, I'm kind of curious, do you think there's going to be a huge backlog coming in the fourth quarter or maybe next year that people will be like, okay, if I go, then I have to actually compete with more companies looking for capital at the same time? I'm curious, John, what do you think?
From where I sit, I do see a backlog. I see a concern on some private equity-backed assets having difficulty raising operating capital. So we are seeing some portcos being handed back to creditors. In some instances, you're seeing them go back to an operating model where they're trying to run it themselves, right, rather than deploy a spreadsheet. So it really just depends. I mean, it's another thing, back to the dual track process, and as Rami said earlier, even a 3-track with a D-SPAC. For what we do, it's very circumstantial. You have to put it to the context. So the D&O has to apply then to the context and the risk profile of what you're pursuing, right? So no one wants to get into an IPO process and then stub their toe and fail. So it's always good to have that dual track. The readiness is all there to be demonstrable in the submission. But really, you're talking about the application of D&O in those contexts where when you're talking about a D-SPAC in this environment where there's very little cash, they may not even make minimum cash coming through. There's no cash to hit the balance sheet concurrently with any raise, with any pipe or anything. Now, the idea behind D&O and indemnification becomes absolutely critical. You're talking about potential insolvency, right, in the first 12 months of the policy. When you're talking about M&A, you don't have that issue. So now you're focused on reps and warranties, and you're applying different cover. So you're not necessarily focused on D&O. You're more lubricating the transaction with transactional liability products. So again, it just depends. that answers your question.
I think you're going to find that people have heard we think the next 6 or 9 months are going to be positive. They've heard that for the last 2.5 years. So, and being ready for an IPO it's expensive. So there's, being constantly ready with a management team that's public company ready, with audited financials, with the legal expenses. I mean, doing that for a 1.5 years is not going to be good for your numbers. So there's a tension between being ready for the next window and actually running your business to make money. So I don't know. I mean, I think people are maybe going to have to be shown that the market's really there before they're really ready to go. The flip side of that, though, is the idea of competing with companies in your industry. I mean, you're already competing with the people in your industry, right? Whether they're public or not. What some people do factor in, though, is they think they're the smartest guys in the room. They think they're smarter than all their competitors, and they don't want to be the second or third IPO because they think the story is going to be completely muddled by the first company that goes public that's not as good as they are. So you do see a little bit of management hubris sort of, rushing to go public.
It's kind of interesting because, like, from the other side of the room, it's kind of like a lot of the times people are saying, oh, we're just going to wait for, especially this time where every single IPO is just almost a single data point, right? They always said, oh, we're just going to wait for Rubrik to go out first before we're going to see if tech is coming back. Do you actually kind of have that sense where people are like, we want to go first, but we don't want to go first?
Yes, I think everyone wants the confidence that there's been some similar companies, but not too similar, that have gone before you that give you some guidance. But once they see that and they're ready to go through their event, then maybe they start worrying that they're not as unique because there was someone similar that just went to market. When you really look at the comps, and in my former life as an investment banker, I did a lot of comp analysis, you realize that there are remarkably few companies that look like yours. And the ones that do, there are so many unknowns. You realize that you really barely understand some of their business models, the business mix, the type of revenue, whatever their risks are. Companies are tremendously unique, and investors, especially when you're looking at an IPO and retail investors, they will have a very unique opinion of what makes your company special or attractive and is investment to them. I think of like the Reddit IPO. There were probably millions of Redditors talking on Reddit about the IPO and so many opinions. Well, what an exciting event that so many people that were consumers of that product could talk about the event and what they were predicting for it. And you see that. Companies are just more unique, and retail investors are seeing them in more unique ways.
And Reddit is very interesting. I covered it, and then like throughout the process, I kind of feel like the sentiment changed a little bit, especially with the fact that they all of a sudden said they are leveraging on the AI, essentially the AI play as well, given that they've got 18 years of data, all the kind of like message threads, and then now they are selling that data to AI companies so that they can actually learn from it. We've seen that with the Stereo Labs as well, and some other companies that essentially saying AI is going to be like the one that is going to break through that kind of multiple of the peers that doesn't actually use AI. I'm kind of curious how much when companies need to come up with a story, they should lean into the AI kind of play. Sherry?
Well, I definitely think it is an area for them to lean into because we're going to see so much of that. But I think the key thing is it needs to be real. And so we heard Karen say on the earlier panel, right, the diligence around that is going to be so important. But it is those who are successful at doing it and doing it first are going to be the winners, I think, in this race. And where AI is going to come and play is, one, on the offering of the company, but secondly, just on how they're leveraging AI in sort of the business and the back office and really helping them, be an accelerator. So I do think one of the things we had looked at, back at the end of 23 is we started to see a lot more disclosures around AI in the S1s. And so, I did a study just to take a look at, how many are talking about it. And there was quite an uptick, and probably I should refresh that now because I'm sure it's grown even more. It was prevalent primarily in the risk factors. So I think companies are sort of tempering the story around AI. But definitely, I think, companies do need to lean into this topic. You hear about it every day, so.
I'm also curious, the next panel is going to be on CFOs and essentially the C-suite. And then, like, what is the preparedness? Because a lot of the times I hear from investors that we know, especially this past kind of batch of IPOs, right? We know their financials so well that we can almost like recite it. So when it comes to IPO, that roadshow, it really comes down to how charismatic that that C-suite, either his CFO or the CEO, how important it is, not only as presenting to investors, but also like as in leading the whole process for the IPO.
Oh, well, I think this actually ties into the question about AI really well, because I think for a while you could get a little allure just by saying we use AI or we're thinking about using AI, but the burden to substantiate how you're using it and to articulate why that's actually valuable to you, why that's a unique differentiator, why it's not replicable will be higher and higher as it's more and more prevalent. And I think that's something companies will struggle with because we're all experimenting, but AI can be so ambiguous that just because we're experimenting with it, it doesn't mean that it's giving us fundamental value.
Yeah, I mean, I think one of the key rules, and Sherry put it very, I don't know, elegantly, I'd say don't commit fraud, you know? I mean, that's sort of a rule.
I second that.
I like to keep my clients out of prison. You know, I think it's easy. Like Reddit has a concrete example. We have this data set. We can license it to someone. That's
already
pretty
generating
easy.
revenue as
Yeah,
well.
you don't have to believe that the people who use it are going to use it for something good, right? Or useful, maybe is the better sense. I won't say good and bad. But you can see it with real estate. You can see it with power. You can see it with you know, basically just giant data mining, et cetera. You can come up with concrete uses for it, but a lot of people will just say, well, we're going to use AI for our business, and you know, I don't know what that means. I don't know if it's going to work or not, or put me out of business. So sort of having a real story and being able to, if you're the management team, really articulate, okay, this is how we're going to use it, is kind of the key. And that goes for, I mean, your whole business is how do you explain it in a way that investors will believe you.
And we're talking about AI in the context of, does this bring some fundamental value to your company? But I get a lot of questions about how AI impacts their ability to create board reports, SEC filings, go through the due diligence process. Like, does this have a direct application to the you know, administrative nature of our compliance process? And certainly everyone's looking at it, right? If you could answer diligence request items faster or compile that list that your attorneys or your insurance provider need faster, more accurately, that's great. But this process fundamentally is about accuracy. You know, is the answer correct? And it's about the replicability of that. If you ask the same question 10 times, do you get the same answer? And I think AI today in its current state is poor at both. So it poses a bit of a risk to the operational nature.
I'll take one on that. So I worked with an autonomous vehicle manufacturer we were discussing AI. And when we did the presentation to the underwriters, they laid out, it was very interesting, where they laid out 5 levels of autonomy. And they went through where level 5 was going to be full autonomous. You were going to be in the back seat with no driver, right? And so we got to the level 4, and they said, realistically, we don't know if we'll ever get to 5. But with 4, the AI is augmenting the driving and the capabilities of the human, where the human makes mistakes, where they get tired, they drop a phone, they look down, they get distracted. The AI helps to augment that. So on a risk profile, that's an amazing thing. When you go further to AI with other businesses, you have to think internally and externally, right? So internally, what efficiencies are we going to create? What does that mean for our workforce? And then externally, we're talking about moving away from D&O into E&O, more of rendering and professional liability. And you're thinking, well, what can possibly lead to a disruption of this service to a paying party or customer that can disrupt their business, that then they're going to look to me as for liability? And so, and then you want to get into another coverage line where you're talking about cyber liability and then media liability, right? Where copyright infringement and those things. So it changes our business a bit, where I still have the focus on the D&O, and then we run downward to see where you can potentially be disrupted.
I think the mention of AI just now, when you mentioned about reporting, it already kind of brought to mind, like there were several, I think for the last quarter earnings, where at least two companies, essentially it's like thousands or millions. Essentially, it's like the numbers weren't right, and then people are like speculating on our side. It's like, and they probably just used AI and then do the first draft of it, and then the person probably wasn't really kind of like matching all the numbers before it was out, and that's probably something that at the back of people's mind need to be aware of when it comes to highly accurate kind of filings and disclosures and press releases, and people have to think about it. Talking about like election this year, I'm kind of curious. So it seems like stable, like the last panel talking about like biotech, technology. There are consumer, which is Vikings, and then some of the industrials are coming back as well. I'm kind of curious for the later part of this year when we are actually kind of like not sure in the environment who is going to win, and then does it matter to particular sectors when you advise clients and issuers and of the timing, when to go, whether the fourth quarter is going to be a good time to go, or what are the readiness? Like, how are you going to kind of survive?
So, I mean, it's like, you'll hear from me a lot, it depends, or companies are very specific, industries are very specific.
That's supposed to be an insurance thing.
It's wow, it's a lawyer thing. It always depends. So, I mean, I think you'll definitely see some industries where investors are unsure about the impact of legislative change on a particular business. I think probably the most prominent example I've had to deal with is whether all of the Inflation Reduction Act incentives are going to stay for renewable power companies or electric vehicle companies or the like. So you'll certainly see some industries where the uncertainty there might be off-putting, might be enough for a company either to rush and go public now, or to wait until Q1 when they know whether something's really there's really gonna be change. I mean, some of it, the problem is change isn't gonna necessarily happen day one of 2025. So the uncertainty, if there is change, could extend for years for certain of these industries. Because as much talk as there is of we hate this policy or this policy, it takes a long time for that to actually get worked through. So.
Sherry?
Yeah, I would definitely say I don't necessarily see, a lot of impact on specific industries. I just think, the uncertainty across the board is impactful. So the more companies can do to be, ready, and we talked about risk mitigation, I think that's going to be very important. And like Rami said, this could take time to actually materialize. So they should be aware of it, but I think, they should be focused on, do we have the right story? Where do we, see valuations? Is there investor buy-in? And are we ready to actually go forward and be public?
And sitting on my side, I kind of feel like the delay in IPO plans, like in the past, it was a big deal, and kind of feel like it, especially over the past 6 months or so, that we've seen so many, that kind of like dampening effect hasn't really hurt a lot of companies. Like we've seen like Reddit, Rubrik, they were all kind of delayed from September last year, and they all they're all going well. So are there last words that you guys want to add on advising companies? The one thing that you're gonna say, go for it, this is the thing that you should look at that we haven't actually mentioned so far.
I think simply going through the process of preparing can be very healthy, and you can learn a lot about your business, some good things and probably a lot of marginal or negative things about your business going through the process. Especially if you're doing a dual track. We talk about readiness for IPOs because you have to prepare to act like a public company before you are. I think companies generally do a little bit less preparation when they think about an exit, just a standard M&A event. So getting ready, getting your ducks in a row, and your reporting can be very good if you go IPO, if you go M&A, or if you do no transaction. All of those outcomes you will probably benefit just from going through that readiness process.
Remy?
So, I mean, I already said don't commit fraud, so that kind of goes without saying. When it comes to IPO readiness, I think Fight Club rules are important. Do not mention the IPO publicly. That's kind of almost goes without saying. Well, so I think Fight Club rules is probably my best advice for pre-IPO companies.
I would say being well-informed and educated on the process with regard to D&O. I think it's a highly dynamic line. It's a financial line. It's a very intimate line, and very few people that are actually insured under D&O policies understand the function and the mechanics of it, how it's actually backstopping the corporate indemnification obligations that they have to you as an individual. Interestingly, we went through our book of business in the last year. We have 11,000 financial institution clients. We have 26,000 D&O clients. And when we compared them with industry sector focus with size, we found a 38% delta between our best performing clients and our worst in their D&O premium experience. So there's a huge delta to chase there in your readiness, and that's really what's contributing to it. So you really have the power in your control.
Yeah, and I guess what I would say is while you're watching the markets, waiting and seeing, who performs well, when is the right time for you to go, take advantage of the runway, right? This is the time to be getting ready and preparing. And there's an element of no regrets work. So whether there's no transaction, an M&A transaction, or an IPO, there are things you can be doing that will benefit the business that you should be doing now while you have the time.
Great. Thank you so much to our panel. Please give a round of big hand to